Thank you. Good morning, students. How are you all doing? How is this topic going on? I'm sure till the last class, which is the only class we have done till now, I'm sure you all would have felt a connect with this topic as well. And I'm sure as we proceed, despite of this topic having many sections, this topic having many A's and Y's and Z's, but still you will like this topic. This topic is very famous for being one of the most litigative topics. When I say litigative topics, it means that in our CA practice, in our taxation consultancy practice, we find continuously there are many court cases, there are many issues, because this topic has so many minute pointers. In fact, last 4 days, I was also attending a RRC conference where we had only two topics for discussion for full 4 days. In those full 4 days, we discussed only two topics. Just a minute, students. So for full 4 days, which started morning 8 and ended evening 9:30, 10, we had multiple discussion sessions. We had sessions where one of us presented. We had sessions where we were continuously interacting, arguing only on two topics, PGBP and capital gain. And still, despite of full 4 days, the topic, the issues were not complete. So this is how you can understand the expanse of this topic of capital gains and obviously PGBP. So yes, very good morning to everyone. Yes, good morning, Navneet, Lingar, Neeraj, Avinash, Ajay, Shamli. Very, very good morning. So let me just revise to start so that you get into that particular tempo again. And then we take up the next part. So we are in the topic of capital gain. Now, as I started, capital gain, people have many misconceptions. First, all capital receipts are capital gain. This is not correct. As I listed out, except HP, you have capital receipts covered under the other three heads of income. So then, can we say that capital gain will cover remaining capital receipts? Remaining means other than those which are covered under the three heads. Answer is still no. Means what? Capital gain has its own method of deciding what will be taxed, and that is decided in the charging section like any other head. Now the charging section also interestingly is not one. The main charging section is 45(1), and then you have multiple other parallel charging sections. Now, what does the main charging section 45(1) says? It says that what will be taxed? Profits and gains, and then it put the two main conditions. What are the two main basic conditions for being covered under the charging section of 45(1)? First, you have an asset which should be a capital asset, and second, the asset should have been transferred. Once both these conditions are satisfied, you go to section 48, which provides the mechanism. It says mode of computation, which I have called as format. Now, interestingly, when you proceed with the computation and you find out the final capital gain or loss, the law says, wait, the capital gain or loss is not of one nature. It has classified the capital asset into two categories, a long-term capital asset and a short-term capital asset. And then the gain or loss arising from these capital assets would be a long-term capital gain or a short-term capital gain. But here I had also given you the first golden rule of this topic. If you remember, we had some golden rules in PGBP, but those golden rules were golden rules for determining deduction as to what deduction you will get, what you will not get. In capital gains, we have golden rules, but these golden rules are for understanding the capital gains and remembering the capital gain provisions. What is my first golden rule? Every provision will have what? What is the golden rule? Every provision will have what? Yes, very good, Divya. Correct, Neeraj. Very good, Dhanalakshmi. Every provision will have. So whatever I am teaching, whatever I am going to explain, remember there will be some exception. This is the first golden rule. So here, when I say that there are two types of assets, long-term, short-term, and the gain arising from long-term asset is long-term capital gain. The gain arising from short-term capital asset is short-term capital gain. Remember, this has its own exceptions where even though the asset is long-term, the gain may be treated as short-term. So, proceeding further, now, what does section 48 tells you? The mode of computation, which in simple words, I am calling it as format. So, for calculating profit on anything, what you require? You require basically two things, the sale price and the cost. Simple. So let us not get into the technicality much. Let us try to understand the provision by its basic logic, basic ideology. So what is the basic logic? The basic logic is that when you subtract the cost of anything from its sale value, you will get its profit or loss. Here, the sale value for transfer of the capital asset will be called as full value of consideration. How it is to be found out is given basically in 48 with multiple other sections, which also act as the exception. Then it says subtract from this expenses which you have incurred at the time of transfer. So for transferring this asset, you have put some advertisement, you have hired some agent. All these expenses, maybe some legal documentation expenses you incur, all this will be full value of consideration minus expenses on transfer. Then comes cost. In cost, there are two parts. First, the first cost that you incurred when for the first time you purchased, you constructed, you acquired the asset. We call it as COA, that is cost of acquisition. This will include expenses relating to the purchase, like what we do in accounts. You capitalize all the expenses till the asset is ready for use. Second is, even in accounts, we do the same thing. After the asset is purchased ready, if in future you incur some further capital expenses, that also you add in the cost of asset. Here, we consider it as a separate cost called as cost of improvement. Again, defined and explained in 55 basically, with exceptions in many other sections. And then the difference is your long-term or short-term capital gain or loss. But this is not the final. You don't compute or pay tax on this because there is some exemption that we will discuss as we proceed. We come to our module, which is our Bible for every subject, every topic. Okay. Now, in this topic of capital gain, we are going to study the scope as to what will be covered under this head. Then, when assets will be called as, or which items will be called as capital asset. Today, we are going to discuss this in detail. Then, when an asset will be short term and when it will be long term. Now, this is dependent upon the period for which you are holding the asset, that is keeping the asset, how to determine that period. Then the transactions, which will be called as transfer, because only for transfer you will have tax. Then the transactions which will be treated not as a transfer. So for these transactions, there will be no tax. Then section 48, the format, how to compute the capital gain. Then finding out cost of acquisition and cost of improvement. Now there is something interesting which is indexed. Today we'll understand this also. And then you will have some special cases of computing capital gain. Then further, as I said, whatever capital gain we are getting is not final. There is going to be some exemption. So what are the exemptions from this capital gain? And then you will get the final capital gain after these exemptions. Let us call this as your taxable capital gain. So first you get capital gain by the format, full value of consideration minus expenses minus cost minus cost. Let us call it as only capital gain, short term, long term, whatever it is. And from that, when you subtract the exemptions which are given under section 54, what is left is the final capital gain, which will become part of your total income computation. So let us call it as taxable capital gain. And then you have different tax rates for different capital gain. In fact, if you remember, in the last lecture, I had said that why the Act has divided the capital gain into two types, long-term, short-term, because for both capital gain, there are different provisions for computation. So for long-term, there is something different in computation. For short-term, there is something different. Then there are different tax rates, and then there are also different provisions for carry forward and set off of the capital losses if they arise. Now, this is the format. Now, in short term and long term, the format is same with one small difference. In short term, you are going to subtract the cost of acquisition, cost of improvement as it is. Whereas in case of long term, when we will proceed further, you will find out that here majorly we deduct the cost of acquisition, cost of improvement as it is, same like short term. However, in some cases, you will deduct this cost or both these costs after indexing it. What is indexing? What is indexation? That we will study. Further important differences, once you've got the short-term capital gain, as I was saying, there are exemptions. There are very few exemptions for short-term capital gain. But when it comes to long-term, you will find that there are many exemptions for long-term capital gain. So basically, in both the computations, two differences. Long-term, in some cases, will have index cost of acquisition, and long-term has many exemptions as compared to short-term. And then the other difference is rate of tax, but I'm not going to talk about rate of tax right now. That will come at the end, because until unless you understand the computation, understanding rate of tax may not be that convenient. Now, as we discussed above, capital assets are either long-term or short-term. Now, how to determine whether your asset is long-term or short-term? That depends upon the period for which you are holding the asset before its transfer. We are going to discuss this period also today in detail. Right now, we are summarizing what we studied in the previous class. Now, there are two different categories. One is 12 months rule, one is 24 months rule. So, for some assets, the rule is that these assets will become long-term after holding it for more than 12 months. Yeah. So, few assets become long-term after 12 months. What are those assets? So if you are having a listed security, I'm sure you all know what is a listed item and what is a security. Security are share debentures bonds. Listed means where they are listed on some recognized stock exchange in India. Two of them you already know, PSC, NSE. These are recognized stock exchange. So only those shares which are listed, or you can say in other words, registered on these stock exchanges, only those shares are traded on that stock exchange. So if your share is registered on any of the stock exchanges of India, which are recognized stock exchanges, recognized means accepted by law, they will be called as listed shares or debentures or bonds. So first item, which has a 12 months rule for becoming long term, is listed securities. Second, mutual fund units. Now, these may be unlisted also, because if they are listed, they are already covered here. So let us say here what is mainly covered is unlisted. Which one? Mutual funds which are equity oriented mutual funds, or which are units of UTI, that is Unit Trust of India. So one is mutual fund units, which mutual fund, which is equity oriented. So there are two types of mutual funds: debt oriented, equity oriented. So debt orienteds are here, equity oriented mutual fund units are here, and then units of UTI mutual funds. And then the other one is the zero coupon bond. So these three assets only are under the 12 months rule. Remaining all other assets, land, building, plant machinery, other unlisted items like unlisted debentures, etc., are in 24 months rule. However, as I said, every provision has exception. Later on, as we'll proceed, you find that there are some assets which do not have any 12 months or 24 months rule applicable. These assets, the gain or loss arising from these assets would always be deemed to be short term. So the exception to the above rule of 24 months and 12 months are these assets. So first, again, mutual fund units, but of specified mutual funds, which are purchased or the mutual fund is taken after 1st April 23. Then those debentures which are market linked, and last is unlisted bonds and unlisted debentures. So these 3 or 4 items are always short term, so they do not have the 12 months, 24 months rule. Then if you remember in the previous class, we started discussing the concept of transfer. So if you remember, I had given you a one-line meaning of what is transfer. Can anybody recall what is transfer? Yes, students, what is transfer? I had given you a one-line meaning. Okay, good, Neeraj. Kuldeep, you are giving me one of the modes of transfer. I'm asking you, I have given you one line generic meaning of what is transfer. Perfect, Ishwarya. Good, Navneet. Very good, Tisha. Again, Nagaraja, what you are saying is right, but it is one of the modes. Perfect, Dhanalakshmi. Neeraj, again, these are different types of transfer, but what you mentioned starting was more correct. Correct, Kuldeep? अब मैं एक फिल्मी डायलॉग मारूंगा, ठीक है? हमारा दिल आपके पास है. Commonly, you all use this commonly in movies. This is how many movies are based on. So something like this. Whatever is mine is now yours. Correct? That is what is transfer. So anything belonging to me become yours. That is transfer by any mode. Perfect lingar. So हमारा दिल आपके पास है. What is mine is now yours. Is transfer. Now, how can this happen? So the law has provided transfer will happen. A transfer can happen. Now understand this, why they have such an extensive list, so that nothing is missed out. Sale is the common mechanism we all know. Similar to sale, you can give and take different assets, that is exchanging one thing for another. In sale, you give asset and you get price in money form. In exchange, on both sides, there is something which is not involving money. Then we had giving away asset without any expectation. Then putting an end to your right. Generally, this happens in case of properties where I have some right. I am giving away my right. Next is where government is forcefully taking away your property. Obviously, because of the power given to them under some law, not arbitrarily. Then I have a capital asset. I change the classification in my books, and now I start calling it as stock in trade. So we say capital asset converted to stock in trade. So still the assets are with me. I've not yet given it to anyone. It is still with me, but only I have changed the classification. Then zero coupon bonds, whenever the period for which the bonds have been issued is over, which we call as maturity. or whenever the company gives back your money, which is called as redemption. Okay, I'm just naming them as a revision. We have discussed all of this in great detail with examples. Next is a practical scenario. So whenever you are buying something, at times you book it when it is under construction. Now the law says the Transfer of Properties Act, which is in short called as TOPA. It says that until unless the property is ready, it is in existence completely, we cannot allow you to sell it legally. Legally means the sale cannot be legally enforceable, because if property is not in existence, then what you have sold. But many times, in case of immovable properties, the transactions happen in advance, and maybe the property can be constructed and become ready in future. Now, in such cases, the buyer was always not having the complete rights over the property, because it could not be called as a complete sale. So to overcome that, a new section was introduced. Anybody remembers this section number? I had mentioned that also. A new section was added to Transfer of Properties Act. Yes, very good, Ishwarya. Perfect, Lingar. Shambli, it is incomplete. But it is right, but incomplete. Very good, Dhanalakshmi. So it is section 53A of TOPA. TOPA is Transfer of Properties Act. Now correct, Shambli. Which says that even if there is no completion of property yet, even if there is no final agreement yet, but if the seller has given you the possession of that immobile property, and whatever is the consideration is paid by you. So the person gives you the possession and you pay the consideration, which they are calling it as part performance. Why part? Because still the remaining building is yet to be completed, but let us say you have booked the ground floor shops or the first floor office or flats, and that is given to you. In such cases, 53 of Transfer of Properties Act says that we will assume there is a transfer even though there is no final sale deed, because that cannot happen legally today. And then finally, there are transactions. There are transactions again relating to immovable property, where what you are selling is not immovable property, but it has the effect of transferring the immovable property. Again, anybody remembers the example? Because again, this was a practical real life example which you all are today also experiencing around you. Yes, tell me what example I had given here. Neeraj, I'll come back to your point. Very good, Linga R. Yes, Tisha, correct. Yes, Divya, perfect. Dhanlakshmi, yes, Kuldeep, right. Ishwarya. Uh, no, Harivansh, it was not building construction. That was for part performance. Yes, Avinash. No, Neeraj, again, that is not the point. Yes, perfect, Linga. So the point was that if you are staying in a housing society, Gokuldham Housing Society, right? So in that, all the flats, all the properties of the society are under the ownership of the society. You, as a flat buyer, are not having the rights over the flat. Rather, let us say there are 50 flats. The society has 50 shares, one share for one flat. And then if you want to buy a flat, though you pay for the flat, what you get is one share. So you become a member of that society by getting a share. So if you buy 3 flats, you'll get 3 shares. Now, whenever you want to sell the flat, what you sell, at least on paper, that is what is the form. The form is you sell the shares. But selling the shares is equivalent to selling your flat. So this is what this last type covers. It says that there are certain types of transactions which on paper, which we say substance over form. So the form is, it appears to be sale of shares. But what is the substance? It is the sale of the flat. So it has the effect of transferring the immovable property. Correct? Now these are the transactions which are covered in transfer. And you will understand from this that the law wants to cover everything here. So any mechanism by which whatever is mine become yours, that is transfer. Now then, coming to what is not transfer. Now this above category covers everything under the sun, but the law does not want to tax everything. Like under GST, firstly supply covers everything, but then they do not want to cover certain things in supply. So they have given you the schedule 3, which is the negative list. Similarly, firstly, under the sun, everything is covered under transfer, but then those transactions where I do not want to tax, I have put them under not transfer. What are those? First is covered under 46(1), remaining are covered in section 47. Now, what does 46(1) covers? There is a company, the company is under liquidation. At the time when the company is liquidating, first it can sell the shares out, sell the assets outside. If it is selling the assets outside and paying the money to its members, its shareholders, it is a sale, it is a transfer, it is taxable in the hands of the company. But if, let us say, the company, instead of selling it outside, is distributing this, giving away its assets to the shareholders, and obviously this is at the time of liquidation. So the company is under liquidation. At the time of liquidation, instead of selling the assets outside, it is relinquishing the assets, giving away the assets to the shareholder. Actually, it is a transfer. Which one? Relinquishment. But I do not want to tax it. So it is not treated as transfer because the law does not want to tax it. So you can say this is the Schedule 3 list of not transfer. Like we have Schedule 3 list for no supply. This is Schedule 3 list for no transfer. Then the remaining ones are covered in 47, similar to 46(1). In 47, the first case is again HUF. There is a partition, maybe full or part partition. And at the time of partition, again, instead of selling the assets outside, the HUF is distributing the assets to its members. So giving away the assets to members at the time of partition is again relinquishment, but the law says not transfer, not taxable. Then you give away your asset. Again, this is another form of relinquishment, either by way of gift or under a will, or you give it to a trust, normally in the form of donation. This will again be relinquishment, one of the types of transfer, but I don't want to tax it. So no transfer. Now, until the last year, gift of ESOPs was out of this no transfer, so it was taxable. However, now gift of transfer, gift of ESOPs is also transfer and it is taxable. Next, third and fourth. are complementary points. So in both cases, there are two companies holding subsidiary, and most important, it is 100% holding subsidiary relationship. Now, in first case, in clause 4, holding is selling to subsidiary, and in clause 5, subsidiary is selling to holding. So either side, transactions are covered. Two conditions. It is 100% holding subsidiary, and the transferee is Indian company. Now, when both these conditions are satisfied, holding subsidiary or subsidiary holding, where the relationship is 100% holding subsidiary and the transferee is Indian company. In such cases, the law says, even though there is a sale, which is the first mode of transfer, but even if I am earning profit from my 100% subsidiary or the 100% subsidiary is earning profit from me, in either case, it will not be taxed. Right? Is this clear? So these two transactions, even though they are sale, but I don't want to tax it. Why? Because ultimately the profit will go to the same person's pocket. Then there are other 9 situations, though all are not covered at inter-level, but those 9 situations follow the same ideology: amalgamation, demerger, and reconstitution of banks. In all these cases, we have the old company, we have the new company. Old company at the time of amalgamation, demerger, gives its assets to the new company. It gives liabilities also, but here in capital gain only transfer of asset is covered, so we are only talking about assets. Similarly, when banks are reconstituted, a smaller bank is merged in another bank, or there is amalgamation of banks, again the old bank gives its assets to the new bank. Again, it is a type of sale only. I'm sure in accounts you all have done amalgamation and even demergers. So old company sells the assets to the new company, but we do not want to tax it. So this is also not transfer. So that amalgamation, demergers, reconstitutions are tax-free and it can be done easily. That is the purpose. Now here, why we have 9 cases? So we have amalgamation, Indian, amalgamation, foreign, demerger, Indian, demerger, foreign. Then you have reconstitution of banks and cooperative banks. So these are in the hands of the companies. Similar provisions you have in the hands of the shareholders of these companies or banks which are under amalgamation demerger. Now, what is happening in the hands of shareholder? Since the main company of which this shareholder is a shareholder is going under amalgamation, now that company, that bank is now closing down. So this person had shares in the old company or bank. Now, since this old company or bank is going in liquidation, it returns these shares, and in exchange, it will get shares in the new company or bank. So this exchange of shares, even though exchange is one more form of transfer, but it will not be taxable in the hands of shareholder also. Again, here 3 cases are covered: amalgamation, demerger, reconstitution. Correct? That is how we have total 9 cases. However, here we are having only 4 out of those 9 in our syllabus, only amalgamation, demerger of Indian companies and the impact on shareholders. Fine. Then other few provisions are government security, which is held by a non-resident. Now, if this non-resident is selling these securities to another non-resident outside India, we do not want to tax it. We want that foreigner should invest in government securities, and after investment in future, whenever they want to sell, it should be a tax-free transaction so that more and more people are inclined to investing in India. But that should be only for government securities. Then Government has issued sovereign gold bonds. Now, whenever the maturity period will come, you will return these bonds and the government will redeem your money. So redemption of these bonds are made tax-free by including it in not transfer. Now, after sovereign gold bonds, a new scheme had come that if you have physical gold, you give it to the government and government in exchange will give you the gold deposit receipt. So it is like making demat of gold, like how we have made demat of our physical shares. Now it is making demat of gold. So you give physical gold, you get receipt, which is an exchange. Vice versa, you give the receipt in future whenever you want the gold and the government gives you gold. So in both cases, there is exchange. We don't want to tax it. Next, if you have some specified capital asset, what are these? These are those capital assets which are of national importance. Why? Because they are some work of art, your archaeological or scientific collections, books, manuscripts, drawing, paintings, etc. of some age-old period. Like people have some 1,000-year-old coins which were earlier used in our ancient India. Then you have some very old monument, photograph, some idol. All these are of national importance. Or you have something belonging to some freedom fighter, the clothes they were wearing, the walking stick they were using, their shoes, their glasses, their hat. All these things are of national importance. Now, these things have a lot of demand outside India, but the government does not want these things to go out of India. So it says that if you sell these things to government or the university, obviously government university, national museum, national art gallery, etc., this transfer will not be taxable. Then comes the other two cases, which again you have dealt with in accounts. Initially, company gave you bonds or debentures. Now you return them, and in exchange, you get shares or debentures. So it is giving back. So when the company issued, it was convertible debenture or bond. Now after 5 years, you return it, and in exchange, you get shares. Or you give bonds, you get debentures. So this exchange not taxable. Similarly, you are given preferential shares. You give it, and in exchange you get equity shares. This exchange not transfer, not taxable. And then an interesting scheme which was for senior citizens that they can sell their assets, their property, their house to banks. Presently, somebody only informed in the previous class that only SBI is offering this, maybe because it is only offered by government banks. So you sell your assets to bank. The bank will not pay you the entire money upfront, but it will treat it as a loan. Now here it is reverse. Bank has taken loan from you because bank has not given you the price for your entire flat immediately. So the bank repays this amount to you in installment every month. Now there are two tax implications. One, you sold the property to the bank, but this sale is not transfer, which is the point covered here. Second side is every month when the bank is repaying back this amount in the form of installment, you are also paid interest on that installment. That is again also not taxable. That exemption you study in other sources. So this is how all these transactions are kept outside capital gains taxability. And then we started with the second basic requirement as to what is asset. Before I go into details of what is asset, let us first have some discussion on whatever we have discussed till now, whatever you have understood, not understood. Tell me. So let me take up some points. Neeraj, I think, had some questions. So let me. Yes, Neeraj had said earlier that we studied in GST that under construction building. Okay, when you receive part consideration, then that will be supply and it is conflicting here. Okay, I understand that. See, understand two, three things better. The first most important thing, everybody, whenever you are talking about different laws, even accounting standard is type of law. Cost accounting standards is also a law. Auditing standard is also a law. And then you have taxation laws within which you have income tax law, you have GST law, earlier you had excise, sales tax, etc. every law is having the right, the power to give its own definitions. So when you say supply, it is a concept exclusively defined only by the GST law. Transfer, here what we are studying, is defined exclusively by your capital gain chapter whenever you are talking about capital gain only. So within income tax also, transfer definition is limited to capital gains. Now, what is interesting to notice, within income tax itself, you may have conflict with the concept of transfer when you go to any other head or any other topic in income tax, because the definition given here of transfer is limited to capital gains. Now, why I'm telling you this? So you cannot say that there is a conflict. Why? Because when a definition is to be given, the law is empowered to give that definition. Why? So that the law can create its own definition and decide what it wants to include or exclude. So what will be included in supply from the purpose of GST law may not match with what is transfer for the purpose of capital gains. In fact, what is transfer for the purpose of capital gain may not match with what is transfer for the purpose of PGBP. So things need not complement, right, beta? And that is okay. That is how laws are, and that is what is the beauty of these subjects. No, Mustafa. If you all remember, I had discussed this point. What is zero coupon bond? Zero coupon bond means where the bonds are not carrying any interest. That is why it is called as zero coupon. You can also call it as zero interest. I'd explained this in the previous class also. So it is not necessary that it will be issued by central government only. It can be issued by anyone. Again, Neeraj, you cannot say it this way. Please understand, Neeraj. Under GST law, we say that GST is applicable whenever the supply is happening in the course of business. Correct. Under income tax, we have a separate head of business. Now, when you have a separate head of business, if you compare it with business, then this part will match, because what will come under the PGBP head is any income arising in the course of business. So that is matching with GST. But if you match it with HP head, with other sources head, or with capital head, then the requirement of business is not there. So again, you cannot say it is difference between GST and IT. In fact, between IT itself, there is a difference. For PGBP head, you need to be doing that activity in the course of business. For other heads, even see, giving away my house property is not my business. I am having that extra house property. It was lying idle. You asked for it. I also thought, chalo, I'll get some money. I have given it to you. It is not my business, but still it is taxed. So within IT head, PGBP head requires that it should be in the course of business to be taxed under PGBP, but other heads do not require. Correct? Yes. Any further pointers, students? Queries, doubts, or any point you all want to share, you all want to discuss? Maybe like how Neeraj is giving comparison, you can give me comparison so that in fact your understanding would develop further. See, it is good way of in fact understanding, because when you compare it with the different topics, it adds to your understanding. In fact, now you'll be remembering it more, because like what Neeraj has done, compared something of IT with GST. So when you compare it, in fact, both things becomes more clear. Okay. Mustafa is asking, if something is taxed in GST, can it also be taxed under IT law? Answer is yes. In fact, it is getting taxed in most of the cases, Mustafa. And you cannot say it is double taxation. Why? Please understand, students, there are different taxes for different taxable events. And the Constitution empowers the government that for different taxable events, you may impose different taxes. Means what? Let us say today, when I'm doing my CA practice, I'm doing consultancy in taxation. When I'm doing consultancy and a client pays me the fees, on that fees there is GST. Earlier there was service tax. But at the same time, at the end of the year, when I add up all my fees, I subtract all the expenses of my business or my profession, I get a difference which we call as profit under accounts or net profit. Income tax again says कि भाई on this you have to pay another tax which is income tax. So effectively for the same fees I have first paid GST, and for the same fees after subtracting expenses whatever is the difference I'm paying income tax. So from that point of view the same fees is getting taxed twice. Is it allowed? Answer is yes, 100%, because there are different laws. The taxable events under different laws are different. And most important, Constitution under Schedule 7, which is the most important thing, has imposed or allowed the imposition of both these taxes. So far as your Constitution allows something, it is applicable, it will be taxed. In fact, I'll tell you, before GST, when we had the earlier tax laws, if I'm a manufacturer and let us say I'm making this pen, I was paying two indirect taxes on this same pen. So when I manufactured this pen, let us say this is for 1,000 rupees and I'm selling it to you. On this 1,000, I first calculated excise duty, which is a tax for manufacture. And second, on the same pen, since I've sold it to you, I was also calculating and paying sales tax. So on this 1,000 rupee pen, there were two indirect taxes, and then there was a third one, which was income tax. In fact, there was a fourth one. When this pen I transported from my place to your place, and it is coming into a different city limits, municipal limits. So your municipality was also adding another tax called as octroi duty, which later on became LBT, that is local body tax. So for the same 1,000 rupee pen, you had the third indirect tax in the form of LBT, and then you had the fourth, which is income tax. Shamli again, see, sale of land is taxable under IT but not under income tax. That is correct. It is taxable under income tax but not under GST. That is correct. Because why? Because presently GST has excluded. But you have another thing called a stamp duty then. And tomorrow you never know. Any law may be revised on any direction. IT law may exclude or GST law may include. Presently, that's what I'm saying. See, the Constitution under Schedule 7 has empowered center and state to impose various taxes. Now, when various taxes are empowered, those taxes may be on the same activity. Same activity means sale of land. So sale is taxed, and then again on the sale difference, the profit is taxed under IT. Again, so depending upon what is empowered by the Constitution, so far as they are imposing the taxes as empowered by the Constitution, you can have multiple taxes. Mustafa, see, I paid GST on purchase of laptop. What is your example? Now, for that amount of laptop, I am claiming depreciation under GST. Whether I will get ITC under income tax, here again you have to understand both these points. Laptop is of 2 lakhs. GST paid at the 18% is 36,000. So different laws have put different conditions and restrictions. Now, the moment I capitalize this laptop, if I'm capitalizing 2 lakhs and not 236, so 36, which is the GST portion, I can take ITC, and on 2 lakhs, I can take depreciation. But if I capitalize 236, that is the GST portion is capitalized, then I don't get ITC of that 36,000. In that case, I'll get depreciation of entire 236. But I can take that 36 as ITC in GST, and on that 2 lakhs, which is the net value of laptop, I continue to get depreciation under income tax. No problem at all. Okay, let us proceed. So we now go on to the next point, which is the second major requirement under capital gain, which is capital asset, which is defined under 214. Now, for the timing, I'll just keep B and C aside because, again, these are some special items which are treated as capital assets. So we discuss about them separately. I first go to the main item which is treated as capital asset. What is capital asset? Section 214 says that capital asset is property. So first point about capital asset is anything which is your property will be treated as a capital asset. So whatever you are holding as your property is your capital asset. Then it says it may be of any kind. Now this any kind means it may be tangible, it may be intangible, it may be personal, or it may be business. It may be movable. So any type of property will be capital asset. So firstly, it says that I can simply summarize that any property held. So anything which is your property is a capital asset. This is the first part of the definition. But as per our golden rule, you should have exceptions. So it says, however, what is not to be treated as capital asset is first stock in trade of business. This stock in trade may be of raw material, consumable stores, finished goods, whatever. So whatever is held as stock in trade of your business, that is those items in which you deal, in which you trade. That is only what is stock in trade. And interestingly, what is stock in trade for me may not be stock in trade for you. Like here, if I'm dealer of real estates, so the land which I'm holding as stock in trade, for me it is stock in trade, but the same land in your hands may be investment. So again, we have to check what is stock in trade, and that depends upon my nature of business. Important to notice why stock in trade is excluded, that is important. And this will give you answer very comfortably. There will be no confusion whether it is stock in trade or not. So what is the logic of excluding stock in trade from capital gain or capital asset? The logic is simple. When you will sell this stock in trade, that amount, that difference is already taxed under some other head. Now, if that difference, that income is taxed under PGBP, why should I tax it again under capital gain? Then it will be double taxation, which is not allowed. So under same act, you cannot tax the same receipt twice. Under different acts, what we were discussing few minutes before, if the constitution has imposed different taxes, it is allowed. So the logic of excluding stock in trade is that stock in trade is already taxed under PGBP whenever you sell it. So the transfer of stock in trade here is not taxed or should not be taxed. That is why they have excluded stock in trade from capital asset itself. Second exclusion is your personal items, which they have called as personal effects. Now, what is important about personal effects is, firstly, it should be a movable property. And second is, it is either for your personal use or the personal use of your family members. So what will be excluded here is your clothes, furnitures, utensils, any item which is in your house for your personal use, even your motor car, both two-wheeler, four-wheeler, your laptops, your mobile handsets, all these things which are personal use items and they are immobile. Now, interestingly, the house in which you stay, it is also a personal item, but it is not excluded. That is why if you sell your house, which is a personal item, which is a personal asset, there will be capital gain because they have not excluded it from capital asset, because capital asset excludes only those personal items which are movable. I hope this is understood. Now, interestingly, personal effect has some exclusions. Means what? These items, even though meant for your personal use, they are treated as capital assets and hence capital gain on transfer of these items will be applicable. What are these personal items? Jewelry, archaeological collections, drawings, paintings, sculptures, work of art. So except A, B, C, D, E, all are used as decorative items in your house. So in your house, you may have these items which are kept as a decorative item, a showpiece, a monument. All these are personal use items because they are meant for your overall family use, but they are treated as capital asset. So transferring them will be taxed. Okay. Now coming to an interesting point. Jewelry is excluded. Now you have a very beautiful definition of jewelry. Jewelry itself is beautiful, but you have also a beautiful definition of jewelry. I want you all to go through this definition. There are two parts in this definition. Try to make your understanding, and then I will be doing some cross questioning to understand what is and what is not jewelry. So read the definition of jewelry. Chalo. Now, if you have read it, let us understand with examples what will be and what will not be jewelry. यस बेटा नीरज. सो घर में अगर सोना चांदी है उसको आप बेचोगे तो कैपिटल गेन है, टैक्स भरना पड़ेगा, राइट. बट इंटरेस्टिंगली उसी सोने चांदी को बेचने पे आपको जीएसटी नहीं लगेगा क्योंकि जीएसटी रिक्वायर्स सप्लाई एंड फॉर सप्लाई it has to be in the course of business. If it is not in the course of business, then in that case there will be no GST. Interesting. Now I will name few items. You have to tell me whether it is jewelry or not as per this definition. Let us see, na, beta. That is what we are going to. Right? Now, let me first clarify. If you have read the definition of jewelry here, now because Neeraj has used the word Sona Chandi, you have raw gold also in the form of gold biscuits. You have raw silver also in the form of silver plates or silver bricks. These are not jewelry. These are capital assets. These are not jewelry. In fact, raw gold, raw silver is what we call as bullion. So where you have these items in raw form, anyways, raw gold and raw silver cannot be said to be a personal effect because it cannot be used. See, what is personal effect? Personal effect is those items which are for personal use, either of yourself or your family. Bullion cannot be of personal use. So it is not in exception anyways. It is anyways capital asset right from start. So we need not even come to the definition of jewelry because it is not a personal effect in the first place. So raw gold, silver, silver coins, gold coins are always capital asset and always taxable. Josh, I did not get your question. So if you have gold in your balance sheet and you have taken some loan, okay. So will the balance of gold be deducted from balance sheet? Deducted from balance sheet means what? I did not get this point. It is a capital asset, yes. Tomorrow when you sell this gold, whether there will be capital gain, answer is yes. Whether you have taken loan or not, that is your different point. See, income tax has nothing to do with. You have any asset on which you have taken loan. Tomorrow, whenever you sell that asset, you have to pay tax on the full sale value. The loan amount and all is not deducted. Okay. Now coming to jewelry. You have gold rings, earrings, different types of piercings. You have this bangles. All these made out of gold, silver, platinum. Is it jewelry or not? You have to say only Y or N. Earrings, nose rings, rings, different piercings, bangles made out of gold, silver, platinum. Great. You have to only say Y or N. Perfect. Good. Now my second question. You have a dress which is made using gold or silver thread. May not be entire dress. Maybe some work on the front portion of your dress, or maybe something, let us say in case of males on the collars or your uh, arms somewhere, some gold thread or silver thread, some decorative work is done. Whether that dress, the shirt, whether it is jewelry, Y, N. The answer is it is jewelry. The shirt, the dress, where you have used gold or silver thread for doing some artwork, for doing any work, like uh, many of your, especially in case of females, different, I'm not getting the word, during your various religious customs, you put on uh, that word, I'm not getting it, is I think chunari or something, where uh, the work in the chunari is done using gold threads, silver threads. This is very common in our India, in different traditions for different religious or marriage and all these occasions. We use those chunnaris or those dresses where some work, yes, zari work is done, which is silver or at times gold. All those dresses, yeah, Tisha, you're right. But nowadays also, like in my family also, people use it. See, silk sari is not jewelry. Dhanalakshmi. Silk sari, because why it is not, this is what we are trying to understand. So silk is not jewelry. Yes, correct, Josh. I'm talking about the same one. Now, next point. Now this is going to be interesting from here. I have this pen made of gold or silver. I have my specs made of gold or silver. Or I have my wristwatch in which either the belt is made of gold, silver, or there are diamonds put inside the watch. Whether this watch, my glasses, my pen, which is made of gold, silver, or having some diamond studded, whether it is jewelry, you have to say Y or N. Why, Neeraj? No, it is not fitting. Why, Tanisha? Previous answer also, Tanisha, was no by you. Is it not fitting in the definition? The pen. Oh, many people are saying no. Acha. Can anybody explain why this pen, why this glass, why my wristwatch made out of gold, silver, or having? Obviously, Neeraj. Obviously, it is not in definition. This is what you understand. So I am asking where it is, why you feel it is not in the definition. What is that point? Harivansh, but is there anywhere requirement of being essential or not? In fact, any jewelry is never essential. Let me tell you, no jewelry is essential. Wearing clothes is essential. In fact, wearing glass is very essential for me. So essentiality, but is not the point. So Harivansh, so what? In fact, every jewelry is luxury. That is what I'm saying. Every jewelry is luxury. So is that the deciding factor? In that case, none of this will be taxed. Chalo, those who feel no or even yes, yes will tell me why yes, because there are many no's which feel that my glasses, if made of gold, if my pen having gold plating, silver plating, or there is some diamond studded, or my wristwatch, or like in case of men, we have those cufflinks or the buttons made of gold, silver, or some diamond studded. Why not jewelry or why jewelry? As per the definition. I'll be back in a minute. So what is your differentiating factor between why it is or it is not jewelry? Again, beta, whether you can sell it or not, Mustafa, is that the deciding point of being a jewelry or not? But again, Lingar, my question, is it a furniture utensil? Answer is no. It is a pen. It is my glasses. See, I'll tell you why many of you felt no. Those who felt no, maybe your reason is when you read the definition is using the word ornament. And you feel, ki, sir, even though what you are saying is made of gold and silver, but it is not an ornament. That is the reason which I feel many of you all have said no. Because now see, let us decode this definition. So what does the definition says? First part of the definition says, in order to become jewelry, it should be an ornament. Then it says made out of gold, silver, platinum, or other precious metals, fine, or of any alloy. And the alloy may be containing one or more such precious metal, fine. So first is the requirement in part one is that it should be ornament. And then it says This ornament may or may not have precious stones. That is okay. So like many times your rings are pure gold rings. There is no precious or semi-precious stones. Still the gold ring will be a jewelry. Why? Because it is ornament. And so there are two requirements: ornament made out of gold, silver. Third requirement is both ways okay, whether with or without precious, semi-precious stones, both will be jewelry. And then whether or not work or sewn into any wearing apparels. So even if it is fitted in some wearing apparel, sewn into wearing apparel, still it is jewelry. Even if not, still it is jewelry. Now here, whether my glasses are fitting, whether my pen is fitting, that is the main point. Definitely is not fitting in the second, right? So we are talking about the first one. Whether the glasses, if made of gold, if my pen, if my watch made of gold is fitting, answer is yes. Why? Those who felt no, why they felt no? Because this condition was satisfied. But their doubt was relating to the word ornament. Because many times we feel that ornament only means something like a necklace, like a earring, like a nose ring or piercing. Not necessary. See, I always say you cannot assume or generalize things, especially in taxation law. So let us try to understand technically. And let me tell you, for any taxation law understanding, you should go by the dictionary meaning first. See the interesting definition of ornament. See, a thing used, no one is saying wearing, huh? A thing used for serving to make something, or here in your case, someone, look more attractive, but usually having no practical purpose, especially a small object such as a figurine. Then another definition, accessories of workshop such as altar, flesh eyes, sacred vessels. Now this is uh, very specific definition, not relevant to us. Let us go to some other definitions. This is the problem. An object that is beautiful and may not be useful. Correct? That is how they are defining ornament. Then another definition of ornament is hmm. Now here it is saying a useful accessory, something that lends grace, beauty, festivity, one who virtues grace, the act of adorning. Okay. Now what you understand from this definition? When you all were reading the word ornament, you visualize only different types of jewelries that you are wearing. But nowhere in the definition, they are using the word something which is wearing. Ornament is anything which is used for beautifying. May or may not have any practical use, but it is for beautification. This is the most important part of this definition. So a pen made of gold, silver is for beautification. Otherwise, gold, silver pen is not required. It has no use as such. A normal pen, what you and me are using is sufficient. But why you are having a gold, silver pen? Because it is for beautifying. It is for showing your status. Similarly, a wristwatch with diamonds is of no use. Without diamond, the wristwatch is still a wristwatch. But by adding diamonds, it is beautifying. It is adding some grace, it is adding some value. So what is important is those who ever said no, they may have said no because they were focusing on ornaments only from the perspective of a necklace or a earring, etc. However, ornament concept is very vast, and hence all these items which I just named are all jewelry. Then comes the second item is furniture, wearing apparels, and utensils. and even other articles. Now, these all articles, again, we use in house when they will be called as jewelry if some precious or semi-precious stones are fitted in this. If furniture utensils are not having precious or semi-precious stones, these will not be jewelry. But if they are having precious or semi-precious stones, these will be jewelry. Yes, just beta, whether single gram gold makes no difference. See, again, don't go by the quantity or the value. A 1,000 rupee item may also be jewelry and a 1 lakh rupee item may not be jewelry if it is not satisfying the conditions of this definition. Tanisha is saying, I'm not able to understand what exactly written in the definition, but now I read it. I understand any precious, semi-precious stones if it is used in making any object. Perfect. Correct, beta. Yes, Disha. Correct. Yes, Dhanalakshmi. Correct. So now you are getting the meaning and the feel. Okay, correct, Jess. That is right. So understand this, students. So the definition concept of jewelry is very vast. And now you'll understand that all these items which are jewelry are going to be capital asset even if meant for personal use. Yes, Neeraj. You have to first check whether what you get from meteorite is it falling in the definition of precious stone. So it should be a precious stones, precious or semi-precious stone. Whether getting anything from meteorite or any such extractions, whether it is a precious stone, that is the main question. Yes, beta, whether made of 18 karat, 24 karat, 20 karat makes no difference because all are considered as precious metal. So this is what is important. You have to first go to the meaning of precious stone, precious metal. Even 18 karat gold is precious metal. And that is why, in fact, they have used semi-precious also. So maybe 18 karat may not be precious because it is not 100% pure, like we normally say 99 for gold and silver items. It may not be 99 or fully pure, but still it then becomes semi-precious. Now I have a very interesting point. In many of our households, we have gold or silver utensils. We have spoons. At times we have silver entire set, which includes a plate, a small cup, saucer, something else made of gold, silver, jewelry. Yes or no? Your answers were expected, and my assumption about the answers was also correct, that you would say yes. And now the beauty. My answer may not be appealing to you. Interesting. Hmm. Yes, just that is the main point. नीरज says definition to cheating कर रहा है. What is the cheating, Neeraj? Interesting point is, after discussing everything and maybe you all concluding something, suddenly I have changed the dimension. That is the beauty, beta. This is how taxation laws are interesting. Again, just why you are getting into the valuation part? Is value important anywhere? See, interestingly, for furniture utensils, you know what is the requirement for becoming jewelry? Fitted with precious stones. Here, furniture utensils not covered. Please read the definition carefully. See, three items: wearing apparel, furniture utensils. These are not covered, this is covered. Here again, three items: furniture, utensils, wearing apparel. All are covered. So wearing apparel, like I gave you example, something in your wearing apparel, some dress, some shirt, or some jewelry where some work is done using the gold or silver threads. It is jewelry, yes. Or in some wearing apparel, there is some precious or semi-precious stone fitted. Like as I said, in your kurta, the buttons are made of diamonds, or in your shirt, the cufflinks are made of diamond. It is also jewelry. Why? Because wearing apparel covered in both. See, but when you see furniture and utensils, it is not covered here. It is covered only here. See the beauty of the definition. So furniture and utensils, right now I gave you example of utensils, plates, small cups, saucers, spoon, glasses, bowls, small bowls, made of gold, silver, is not jewelry. Why? Because utensils, furniture will be jewelry only when fitted with precious, semi-precious stones. But only because they are made of gold, silver, they will not be jewelry. Please check the definition. I'm open for discussion and arguments. So, Shraddha, whether ornament includes, that is now the main point, whether ornaments will include furniture items or utensils. Utensils are of personal use. Ishwari, I am not arguing on that. See, personal use items are out of capital asset. But within personal use items, if it is jewelry, it is taxable. Agreed. But point is, for being jewelry, there is no requirement of it being of personal use. For being jewelry, the requirement is ornaments made of precious, semi-precious metals and wearing apparel, furniture, utensils fitted with stones. Now we have to only understand whether ornaments includes utensils. That is the main point. It is not about use. Just see why it is wrong. Please understand, students. Remember one thing. You are studying law. You are not the law. You are not the creator of law. You cannot say something is right or wrong in a law. If you have to say something is wrong, then you have to go to the superior law, which is constitution, and then say, okay, this is wrong because this is going against the constitution. Simply because it is not going against your understanding, that cannot decide the right or wrong of a law. You may not understand it, you may not like it may not fit in your logic, that is fine. So whenever you are creator of law, you can create the law as per your understanding and we will accept it. Law is something which has to be followed. You cannot decide the correctability of law. Because if everybody start deciding, somebody will feel this should not be jewelry, somebody will feel this should be jewelry. But that is not how law is. Tisha Beda, again, why you all are linking it with personal use or no use? The simple point is ornament meaning. If it is ornament, it will become jewelry. But utensils, furniture, nobody will call it ornaments. Please understand. Correct? Yes, Navneet. So conclusion is, if you are having utensils made of any precious metal, it will not be jewelry. But if the same furniture utensil is having any precious, semi-precious stone, it will be jewelry. Again, just don't mix it between asset side of balance sheet, because asset side of balance sheet has everything which is your property. Please understand, out of all the assets on your asset side, certain items will be capital asset as per capital gain chapter, but doesn't mean the other items will not be balance sheet assets. They will be balance sheet assets. So Tanisha beta, that is the first golden rule of my capital gain chapter. That is my first golden rule for this chapter, that there will be exceptions. So be ready and be open for exceptions, right? That is the beauty of the subject. So Tanisha, the utensils, if fitted with any precious, semi-precious metal, will be jewelry. If made of gold, silver, will not be jewelry. If not jewelry, they will continue to be of personal use and hence not asset. So final answer is utensils. Simple example, you have plates, you have glasses in your house made of silver. Generally, we have silver utensils, and you are using it occasionally or makes no difference. It is not necessary that for personal use it should be used daily. Even if it used occasionally on some festivals or for some rituals, it will not be a capital asset, because first it is of personal use, and within personal use exception, jewelry is only taxable, but it is not jewelry. So simple, jewelry is taxed, but utensils made of gold, silver is not taxed. And if utensils are fitted with diamonds, it will be taxed. Correct? Great. Then comes the third exception, which is a simple one. Two requirements. First, the land is agricultural land, and second is it is a rural area. So here, this is what is not a capital asset, hence not taxed, because we are reading the exceptions to capital asset. Now, important point is agricultural land we all understand, but what is rural area? Interestingly, the law has not defined rural, it has defined urban. So whatever is outside this urban area will be rural area. And if it is an agricultural land in this area, which is outside the urban area, then we call it as rural agricultural land. Now, let us go to the definition of what is urban. Correct? What is urban? Urban first is the area which is falling under the jurisdiction of a municipality, cantonment board, etc. This is urban. So then what is parallelly rural? Which is falling under Gram Panchayat. So where there is no municipality or where there is no cantonment board, that area will be rural. But if there is a municipality, like many of us, we are staying in cities which is covered under municipality, municipal corporation, etc. So that will be urban. Now, if there is any agriculture land over there, it is taxable. Now, interestingly, second part of this is that the population should also be at least 10,000. So municipality plus population of 10,000 or more. This makes it urban area. Second part in urban area definition is, let us say this is your city limits. So this is your city, and this is the boundary of your city. Now, since your city is having population of 10,000 or more, and plus there is a municipality, hence this city will become urban as per part A. Now, what does part B says? Not only this city limits, but some area beyond the city limits will also be urban. How much area? For that, this table is given. Now, if the population of your city is above 10,000 but below 1 lakh, then how much area outside your city limits will also be urban? Up to 2 kilometers. But if the population of your city is greater than 10 lakhs, greater than 1 lakh, less than 10 lakhs, then area up to 6 kilometers beyond your city limits is also urban. And finally, if the population of your city is greater than 10 lakhs, then area up to 8 kilometers will also be urban. Now, please understand what is the logic. So, the city limits where the city is covered under municipality becomes urban, no doubt. But urbanization does not stop at the city limits itself. Let us say you are staying in some very developed city, Bangalore, Hyderabad, Delhi, Ahmedabad, Mumbai, Indore. All these are developed cities. Now, you will find that there is some municipal limit. Like, for example, Mumbai, you cross some, I don't remember the name. There, the municipal limit ends. Then you again have Thane, which is another municipal limits. Let me tell you, Mumbai and Thane are two different municipal limits. Let us say the place where Thane ends. Is it that exactly at that point, suddenly you'll have no buildings, there is no roads, nothing? No. Beyond Thane, even though the municipal limits of Thane has ended at some point, you will still find huge buildings. You will still find all facilities similar to that of a proper city. So whenever a city expands, it expands even beyond the city limits because many times staying in proper Thane or in proper Mumbai may be costly, but just staying 2 kilometers outside Thane may be more easy. Easy means less costly because that is also developed and that is where also you have all the big buildings and everything. That is why the law said in point A, the city which is covered by municipality is anyways urban, plus some area beyond your city limits will also be treated as urban. Now, this area may be 2 kilometers, 4 kilometers, 6 kilometers or 8 kilometers from your city limits, depending upon what is the population of your city. So, your city as per point A is urban, and this area beyond your city as per point B is also urban. Now, if the agriculture land is outside this area, then only it will be called as rural agriculture land and it will not be treated as an asset. And then there are these three different types of bonds issued in different years, which will be not treated as capital asset. So if you have specified gold bonds, special bearer bonds, gold deposit bonds issued in these periods, it will not be treated as capital asset. So student, these are the exceptions to capital asset. Yes, Disha, correct. So Virali, if you have a gold cup saucer, it is utensil, it is not jewelry. But if there is some diamond fitted in that, it becomes jewelry. You're right. Chalo students, too much technical discussion. People are requesting for break. Anyways, we have discussed for now more than 1 hour, 35 minutes. So let us go for a break. We have a 15 minutes break. We come back and we proceed with more detailings about nature of a site, long term, short term, everything. Fine. So 15 minutes break, students. find a particular thing not so matching with your logics. See, the same thing used to happen with me when I started studying. The reason is I realize one thing that when we study, we try to generalize things or we try to fit things in our understanding, which may not be the case always. Because when you will progress further in your CA curriculum, different subjects within taxation, different topics, and when you will start actually following our finance ministry, the budgets, then you will start understanding why these amendments are in such a manner, or the definitions, or the exceptions, explanations, why they are so different. At times, it may not appear to be matching your logics, but if you understand the reason why these were created, under what circumstances these were created, then you start understanding their logics. So I'm sure because that I thought that you should know, so I gave you that detailed understanding of jewelry, because at inter level you will not have any challenges, because at inter level straightforward in the question they will say jewelry, nothing else. But when you go to final level, you will study cases, and at that time it should not happen that today you have made some understanding and suddenly at final level where you thought that this should be jewelry, this will not, and suddenly it will change. That should not happen. That is why I had given a proper 10 to 15 minutes time only on making you understand the concept of what is and what is not jewelry. So yes, but if you are selling these gold utensils, which is now not jewelry, and if it is not jewelry, hence it is not capital asset, so the income will not be taxed anyway. Why? Is it salary? No. Is it house property? No. Is selling this your business? No. And let me tell you, it will not even fall under other sources. Why? Because the other sources covers residuary, I agree. But anything which is specifically excluded by a particular head cannot automatically be covered under other sources. Hence, it will not be taxed over there. But beta, why you need to cover gold and silver into utensils? See, you may do that. People are doing that. But then what happens? Understand one thing. See, simply covering into utensils is not sufficient. Then you should also be able to prove personal use. Understand this. We were discussing the point of personal use. If you are able to prove that that utensil, that furniture is personal use, definitely you can save capital gain tax. But a selling bullion is fully taxable. Bullion is capital asset always. Yes, correct, Kuldeep. You have to avoid personal emotions. So students, this is the summary. What is the summary? The main definition of capital asset says what is capital asset: property of any kind. Then it gives exceptions. Exceptions are stock in trade, personal items, rural agriculture land, and the different bonds. Within personal items, even if you are using something for personal, but if it is jewelry, archaeological correction, drawing, paintings, etc., it will still be taxable. So personal use items excludes these five personal use items, which will be taxable. Now we go to the remaining two parts of the capital asset definition. There are two other items which will be regarded as capital asset. What are they? Securities, which are held by foreign institutional investors. So you have those investors which are institutions like companies, like mutual funds, but they are foreign. So it is a foreign mutual fund or a foreign investment company. When they are investing in India, they are called as FIIs. Now, these FIIs, when they are investing in securities in India, we have treated their securities as capital asset. So whenever they sell their securities, they will be falling under capital gains. And next, there is a unit linked insurance policy, which is not exempt under 1010D. So when you will study other sources, you'll get to know what this is. So the insurance policy, or not insurance policy, actually it is a unit linked insurance policy, which is ULIP. is also treated as a capital asset if it is not exempt over there. If it is exempt, then the point is over. No, beta, bullion is a capital asset. I told at the start, bullion cannot be of personal use. The moment bullion cannot be of personal use, it is anyways capital asset. Why you come to jewelry then? I mentioned this at the start itself. You remember? But a capital asset, if transferred without consideration whether it will be capital gain, the answer is yes, if it is fitting in transfer. So you tell me, give me a practical example of this, that you have transferred a capital asset without consideration. If it is fitting in your transfer, 100% it will be taxable. See, in case of this capital gain, there is nowhere requirement given of consideration, right? But tell me a practical case of transfer without consideration. See, theoretical, you can say anything, but if you give me practical, then we will analyze it with the definition of transfer or not transfer, and we can definitely get the answer. So, but if you are giving it at the time of marriage of daughter, is it not gift? And if it is gift, it is excluded from transfer. We have exception to transfer. Na? That is why I'm saying the moment you give practical example, you'll also realize they have already made proper provision in the definition of transfer itself by giving a list of what is not transfer. So where you are giving something by way of gift or donation to trust, it is anyways not transfer, right? We have already discussed this in the first class also. When an asset will be short term or long term. Now what it says, asset will be short term or long term depending upon its period of holding. Now please understand this point. What is period of holding? The date of purchase and the date of transfer. I'll change my word from purchase to acquisition. So date of acquisition, date of transfer. Now, this is your period of holding. Now, when we read the definition of short-term asset, which is given under 242A, what is interesting to notice, they are saying don't count up to this date, count up to a date immediately prior to this date. So, if this period is exceeding the 12 months or 24 months, then your asset will be long term. If this period is equal to or less than 12 months or 24 months, then your asset is short term. Now, for which asset 12 months, which asset 24 months, this we have already seen. What is important to note is what is period of holding? Because period of holding exceeding 12 months, 24 months will make your asset long term. But what is period of holding? So the date when you acquire the asset, the date when you transfer the asset, this is period of holding. However, when you read the definition of short-term asset, it says you have to check the date up to the date immediately preceding the date of transfer. So don't count up to the date of transfer, take the previous date. If let us say transfer is happening today, 23rd of December, you will count up to 22nd. So from the date of acquisition till the date of one date before the date of transfer, check this period. If this period is exceeding 12 months or 24 months, your asset will be called as long term. And then we have exceptions for these three assets. No need to check the periods. It will always be short term. Now we had this word equity oriented fund. I had already explained to you what are equity oriented funds. So equity oriented funds are those mutual funds under which a major portion will be invested in equity shares. So where a major portion is invested in equity shares, the fund obviously becomes equity oriented fund. So there are two categories in this where different criterions are given of investment in equity shares. But for the time being, you need not learn them. You will not be asked any theory question on this. Zero coupon bonds also I explained. These are the bonds of companies which are not carrying interest. Now coming to an interesting part. We just saw above what is period of holding. So period of holding is this, correct? Acquisition to transfer is the period of holding. And for finding out long-term, short-term, you have to take the date immediately, the date of transfer. Now again, this rule, that period of holding is from acquisition to transfer, this rule has some exceptions. These exceptions are given in explanation 1 to the definition of short-term asset, which is under 2 bracket 42A. Now, what is this exceptions? So basically, these exceptions says that period of holding will not be from here to here, it will be something else. But the general rule is, say again, understand my logic. What is period of holding? The period for which you are having the asset with you. That is your period of holding. So जब तक asset आपके पास है, that becomes period of holding. Now the main part. There are some specific cases where this period of holding will be something different. First case is where a company is under liquidation and you are having shares in that company. Now let us say you had acquired shares on a particular date, let us say 1st of October 24. You had purchased the shares. So this is the starting point. Now, somewhere here, 15th of September 25, the company goes in liquidation. So company files the liquidation application and the court grants it the liquidation. Now, when the company goes under liquidation, you all would have studied in accounts, maybe in company law. Now, what the company has to do, a liquidator is appointed, and the liquidator will start liquidating the assets of the company and paying off the debts. And then there is a sequence given, preference given as to which debt will be paid first, government dues, then creditors, secured, unsecured, everything. And after paying everyone, your number comes the last. You are the equity shareholder. Now, importantly, you purchase the share on this date, and on this date, when your number comes, let us say this is today, you return the shares back to the company and you get your money, right? Now, effectively, you have held the shares from this date to this date, because on this date, your turn comes to get the money. So you return back the shares to the company and you get your money. Now, what is the special point? Now, the general rule is period of holding is from date of acquisition to transfer. However, this particular table gives you the exceptions or the special cases where it says this period is excluded. It means for shares of a company which is under liquidation, the period of holding is counted only from here to here. This part is excluded. So what it says, period subsequent to date of liquidation has to be excluded. So here the special point is you will not count the full period for deciding period of holding, for deciding the 12 months, that is long-term, short-term. You will decide or take the period only between this patch. This is the first special point. Now comes my golden rule number 2. Now, what was golden rule 1? That whatever you study, there has to be exceptions under capital gain. What is golden rule 2? Please pay attention because this covers 30 to 40% provisions sections of capital gain. Whenever any capital asset is acquired by assessee in one of the modes, which is not So the golden rule, which I am now going to explain to you, is that whenever any capital asset is acquired by you and it is acquired in one of the modes which is not regarded as transfer. So the mode or the method by which you got the asset, you acquired the asset is not regarded as transfer. Now, what it could be, you got the asset by way of gift or under inheritance or under will, or in your subsidiary, you got it from holding. All these are cases where you acquired the asset, you got the asset, and that method is not treated as transfer. Now, what will happen? Period of holding. Now, what is our general rule? You count period of holding from the date when you acquire the asset. Period of holding includes period of previous owner or previous asset. What it means. Now again, you receive the asset by way of gift on this date and you transfer it on this date. Now what is our general rule? You count the period of holding from the date of acquisition, how you acquired the asset by way of gift, up to the date of transfer. And for long term, short term, we take the date, one date prior to the date of transfer to count the 12 months, 24 months. Fine. Now, what does the law says? If you have acquired the asset by any mode, any mechanism which is not treated as transfer, then in that case, your period of holding will not be counted from here. Your period of holding will go back to the date when your previous owner had acquired the asset. This is what is the golden rule. This golden rule is applicable if your capital asset is acquired by you in a way which is not treated as transfer by the act. Then your period will start from here. So your period of holding will be counted from the date of acquisition of previous owner. I hope you understood this, students. Right? Now there is one more part in this, but that is not right now my point of discussion, so I will not talk about it. Now, since we are discussing period of holding, my golden rule 2 will apply to so many cases. See, so in so many cases, our golden rule 2 is applicable. What is the first case? The asset became your property by virtue of 49.1. And when you read 49.1, it covers majority of the cases which we studied in not transfer. What it says? Period for which the asset is held by previous owner is included. Next golden rule, where it is applicable, where shares in case of amalgamation. So you are the shareholder, you give the old shares and you get the new shares. Now, what is the period of holding of this new share? The period for which the shares were held by the assessee in the old company are included. So you count it from the date of previous asset. Similarly, in case of demerger, same rule. After demerger, you gave the old company shares back and you got the new company shares. What is the period of holding for this new company shares? You acquired it today, but it will be counted from the date when you had acquired the old company shares. The period of holding when the old shares were acquired will be counted from that date even for the new shares. Again, you have got equity shares. Why? Because of conversion of preference into equity. You remember, this is not transfer. Now, what is the period of holding for equity shares? The period of holding for equity shares will be counted from the date where the previous asset, that is the preference share, was purchased. Similarly, you have electronic gold receipt, right? How did you get this? By depositing gold. So you gave gold, you got the electronic gold receipt, or it is vice versa. So gold to receipt or receipt to gold. Now this was not transfer. You remember this? Again, the period of holding for which the gold was held is to be checked. So for receipt, you take the date when the gold was acquired. Similarly, for gold, you take the date when the receipt was acquired. In all these cases where it is not treated as transfer, the period of holding is counted from the date of previous owner or previous asset. So this is what is the important point. Good. Yes, we are dealing with the exceptions only, na beta Tisha. Right, students? Then we go to some more provisions. Now, inventory of business is converted into capital asset. So SIT converted to capital asset, period from the date of conversion shall be considered. Then share or any other security subscribed by the assessee on the basis of right. So it means you're talking about right shares. The period is counted from the date of allotment of such share. Then before right shares, you get the rights. Then using the rights, you purchase the right shares. Now what is the period of holding of these rights? The period of holding of the rights is starting from the date when the rights were offered. So the date when the company offers you the rights to purchase the right shares, that is the starting point. Then comes bonus shares, that is financial asset is allotted without any payment. Again, the period is counted from the date of allotment of the bonus shares. Then sweat equity shares, again the period is counted from the date of allotment of such set equity shares. And then finally, period of holding in case of other capital asset, the period from which the capital asset is held by the assessee shall be determined in accordance with rules made by the CBDT in this behalf. CBDT has made Rule 8AA to provide that the method of determination of period of holding of assets other than assets mentioned in the above explanation. Specifically, in case of capital asset being share or debentures of a company which becomes property of the assessee in circumstances, there shall be included the period for which, again, same rule. Where you got the share securities under 4710, which is not transfer, what will be included? The period for which the previous asset prior to conversion, that period is included. So it is following our golden rule that whenever you receive asset in one of the modes which is not transfer, for you, the period of holding will not start from the date when you receive this asset. It will start from the date of previous owner or from the date of previous asset. Means for the case exclude, another all case include. Okay. So students, with this, we complete the concept of capital asset. So we understood what is asset, we understood what are exceptions to asset, and we understood how to determine long-term, short-term, mainly how to find or calculate the period of holding. Now we come to our charging section. Now, once there is asset and the asset is transferred, you are liable to capital gain as per your general charging section. As I said here, you have some more charging sections, but firstly, you have the general charging section, which is 45.1. Now, what does the general charging section says? As I explained, if you get any profits or gains, how? By transferring a capital asset, then tax is leviable under this head. This head means capital gain head when it is applicable in the year in which transfer took place. So in short, when they want to tax it, they want to tax it in the year of transfer, right? So now we start with the charging section part. First is general, 45.1. There should be capital asset. The asset is transferred. Most important, minus not covered under section 54 exemptions. I hope you remember the format. There are some exemptions. One second. Interestingly, exemptions are also under 10. Now, so there is an asset is transferred and you are not covered under any of the exemptions, then capital gain is taxable when in year of transfer. So what is the rule given in the charging section? If you satisfy the conditions of charging section, that is asset and transfer, and you are not covered under any exemption, then the capital gain will be taxable in the year of transfer. Very good. So this is the rule. Now, whenever there is a rule, my golden rule says there will be exceptions. So the rule is taxability is in the year of transfer, fine. But in some cases, taxability will happen not in the year of transfer, but in some other years. That is the beauty. What are these exceptions? That will come one by one in different sections. As they come, we will discuss. So the charging section says capital gain will be taxed in now. Shraddha is saying, sir, can income from sale of jewelry invested in buying a property, that is house, attract capital gain on sale of jewelry? No, beta. Sale of jewelry. See, firstly, if it is jewelry, it is a capital asset. Yes. Whether capital gain is attracted, yes. Whether you invest it in something else, that does not determine whether capital gain will attract or not. Capital gain attraction is determined on two things: asset transfer. That's it. Once those two things are satisfied, capital gain attracts, irrespective of whether you invest or not, or if you invest, where you invest. Both things makes no difference. Fine. Now, so what is the charging section saying? Transfer, asset, both things satisfied, we will levy tax when in the year in which the transfer is taking place. Now, however, we have exceptions. In case of certain receipts, the year of chargeability is not the year of transfer. First, insurance. Second, conversion of CA into SIT. Third, compulsory acquisition. Achha, there are two more, may not be covered in your syllabus. Okay. So, what are we discussing? We are discussing charging section which says capital gain is chargeable in the year of transfer. Exceptions. Insurance claim. Year of receipt of insurance claim. So what is the first exception? Your asset is getting destroyed by fire, by earthquake, by flood, by tsunami. And this is happening in 2023-24. However, it takes 2 years for the company to pass your claim. So they pass your claim in 25-26, that is in the current year. Even though the asset was destroyed in 23-24, the tax will be applicable in the year of receipt, which is 25-26. So first exception to the rule that you tax it in the year of transfer. There is one more insurance claim, though it is not covered in that list, but I'm sure it will be there somewhere later. So we'll discuss it at that time. Then comes the second case of capital asset converted into stock in trade. We saw this in the definition of transfer. I'm having a building. For me, it is the capital asset. But in this year, in my balance sheet, I changed the classification to stock in trade. This change in classification in my books is treated as transfer. However, please understand, students, today when I change it to stock in trade, effectively, I have not given it to anyone. Still, the asset is with me. There is nothing which has happened actually. Only the classification has changed from top to down. Now, the law is treating it as transfer, that is fine. But when it will be taxed, it will be tax sale of, this is year of chargeability. That is the year in which a capital gain will be taxed. Here it will be taxed not in the year of conversion, but in the year of sale. Again, we saw this in the definition of transfer, that the government is empowered by different laws to compulsorily acquire your property. Now, let us say in 2020-21, when the government decided to do expansion of certain roads to make it highways, 6-lane highways, my land was falling on that road. So the government asked me to vacate that place so that they can use my land to make the highway, the 6-lane national highway. Fine. Even though I agreed or not, I did not have any choice because there are different land acquisition acts which empower the government to do so. So in 2020-21, my land was compulsorily acquired by the government. Now this is the year of transfer, fine. However, tax is applicable in the year of receipt of first installment of the compensation or enhanced compensation. So in case of compulsory acquisition, the year in which my property is compulsorily acquired, I don't have to pay tax. I will pay tax in future. The year in which I receive my compensation may not be full. Even if I receive the first installment, I will pay tax. Understood? See, so these are some exceptions where I don't pay tax in the year of transfer, I pay tax in some future year. So these serve as exceptions to the main charging section or to the main provision that tax is applicable in the year of transfer. Understood, students? Clear? Anybody, any doubts or questions? So we have discussed till this point, that is transfer, not transfer. Fine. Coming to section 48, which deals with format. This also I explained at the start. The format simply says that you find out the full value of consideration, and from that you deduct two things: expenditure incurred wholly exclusively for transfer. This will be brokerage, stamp duty, registration, legal, and the cost, which cost acquisition and improvement. So when you subtract this, what you get balance is your capital gain or loss. Now again, every point has an exception. So first exception is, though I am allowing you to deduct expenses on transfer, you cannot deduct one such expense on transfer, which is STT. Now interestingly, if you are selling any securities on stock exchange, the stock exchange will collect from you securities transaction tax. However, the law says we will not allow you deduction for the STT, that is securities transaction tax. Now, it is interesting to note, had this been my business, that is, if I would have been in the business of selling, purchasing shares, then this income would have gone under PGBP head. And interestingly, under PGBP head, I get the deduction for this STT. So strangely, or rather interestingly, under the same act, Income Tax Act, under different heads, the rules are different. So where sale of shares is part of PGBP because I'm in the business of purchasing, selling shares, I get deduction for the STT paid, which the stock exchange deducts. However, if I am not in the business, shares are held as investments, which is the case in many of our case. When these shares are sold, again the stock exchange will deduct STT. I will not get any deduction. Nagraja, what are you saying, madam? Okay, you said you got it. But that is the case always, Mustafa. You will have to read this. You will have to read it multiple times. Only then the things will consolidate. So there are so many things in every chapter where you will be able to understand only when you read it yourself. Now in computation, if you remember students, we had something called as indexation. Now what is this indexation? Now let me tell you, up till 23rd July, that is in the last year, indexation was applicable on transfer of all long-term capital assets. So until last year, indexation applied in cases of capital assets, all capital assets, again with few exceptions. Now, interestingly, this is before. Now, interestingly, from 23rd July, indexation does not apply. In short, the concept of indexation has been removed from capital gain chapter in the last year from 23rd of July. After doing this, there was a lot of UN cry, there was a lot of, you can say, sort of protest or something, where the government then brought an exception. What is this exception? If you are individual HUF and what you have is land or building, you are given option to compute your capital gain. Obviously, this should be a long-term capital asset because indexation applied only to long-term assets. So you are given an option to find out capital gain with indexation or without indexation. So now what is the present position? The present position is, you can just keep in mind, indexation has gone. It means whether your asset is short term, long term, calculation is same. So in fact, from you, that is from your side, from a perspective of student, in fact, it has become easy now because they have removed indexation from the act. So now there will be no indexation under Income Tax Act. However, only in this one case. What is that case? Your individual HUF, the long-term asset is land or building. You are given a choice. So still here, indexation is not compulsory. You are given a choice that you can calculate. Now, what is the choice? You can do it by taking indexation benefit or without taking indexation benefit. How it is done, that you will study when you go to that computation, because now only in this one specific case indexation remains. In all other case, indexation is removed. So we will discuss indexation only when we go to that particular point. Otherwise, indexation is not applicable. So I'll take questions if any, and then we'll close. So we have studied up to the computation part, up to section 48. So we have covered entire transfer, entire capital asset. We have covered charging section with exceptions, and we have covered the computation mechanism. What are the questions? Nagaraja is asking, sir, no one cases property in village transfer to in rural area not considered capital gain. I did not get your question, but what I'm getting to understand is, if you have a land in rural area and if it is transferred, and you are using the word village, so it means you are representing rural area, whether there will be capital gain. Okay. See, understand this. 2 points have to be understood. Nagaraja, point one. Firstly, is it rural area as per the definition? So village generally will be rural area, but see, city limits and beyond city limits also 268 kilometer will be urban. So your village should not fall in that 268 kilometer, point number one. Second, the property in the village should only be agriculture land. If you are having a house in village, if you are having any other property in village, everything is not exception. Exception is only one thing, Nagaraja. That is agriculture land in rural area. Correct? Yes, beta. So now on transfer of any asset, there is no indexation. Whether it is plant machinery, whether it is land building, anything, there is no indexation. Only in one case, indexation is allowed, that also as a choice. Pranav, sir, ETFs and commodities on stock exchange will be 12, 14 months. See, if they are listed, definitely it will be 12 months. Pranav. So generally they will come under listed only if you are saying it is on stock exchange, so it will be 12 months. Right. Yes, students, from my side, I've completed what I had planned to complete up to working, that is computation, that is section 48. Now from next class, we are going to do practical sums of actual computation in different scenarios. I request that you come reading up to this point. Maybe you can read further points also. It may create some confusion. Don't worry. When we will discuss in the class, everything will be sorted. So, anybody, any questions, students? Yes? No questions? Mustafa is asking, sir, we have next class on Tuesday, but I don't remember the schedule, which is whether it is on this Thursday or not. So whenever it is as per schedule, that will be taken with it. Kuldeep is asking why indexation. Kuldeep, that will discuss now. Right now, since indexation is removed, so let us not focus much, but we'll do with indexation when it comes. See, if father is transferring, means selling land to son, it is taxable. But if father is gifting or by way of will, it is giving to son, it is not transfer. Why? Because it is specifically excluded from transfer. So when father gives to son, you have to check the mode, whether it is by way of gift, will, inheritance. In those cases, it is not transfer beta. Otherwise, if it is proper sale, it is transfer. Sir, we read consumer price index in foundation. Yes, beta. So it is same. That is what is In fact, same means that is what is the basis of indexation. Kuldeep said, while reading the law, we lost some time. Means what, Kuldeep? I did not get your point. Which law, beta? Which law, beta? Kuldeep, I did not get your point. So means what? IT means? I didn't get your point still. You may unmute and let me know. That means without C capital gain. What is this, Nagaraja? Without C capital gain. But please make your pointer specific and elaborate so that I will understand. Lina is saying, sir, it is jewelry because it is first part of definition. I think this was old message by Lina. Mustafa is saying, okay, beta. So that schedule, I haven't checked what is on Thursday. But if it is a holiday because of 25th, then obviously we meet on Tuesday. Divya Jain, yes, thank you. Yes, Lingar, yes, thank you, beta. Thank you very much. Students, anybody, any further questions, doubts? Yes, Nagaraj, I'll unmute you.
So that means without consideration transfer to relative parties, not to consider the capital gain.
Please, beta, don't say without consideration. Say whether it is gift, whether it is will. If yes, no transfer. So please check what is without consideration, the nature. Gift, will, without consideration, no transfer. Not taxable under capital gain. Correct?
So because some person saving tax, so transfer without consideration to marriage daughter and
So better
son.
then it is gift, na? Then say gift. If it is gift, it is not taxable under capital gain. Correct?
Yes, sir.
Yes. Kuldeep, I still didn't get your point. Reading the law, income tax, I didn't get that point. If you have any questions on that, please explain. Pranav says, sir, other than exceptions, if any other capital gain is taxed in that year itself. Yes. So, except for the exceptions, all other capital gain are taxed in the year of transfer. Only in case of exceptions, it will be taxed in the year which is mentioned in the exception. That is some future year. Perfect, students. Then, thank you very much. I'm sure, especially the discussion on jewelry would have given you a new angle of reading the law, which is very important. You should understand how to read. See, if I'm teaching you something, that is okay, great. But I want you to develop to read the law yourself because tomorrow you will be doing it by yourself. So that is why, wherever required, I'll take you to certain specific portions of the act itself so that you yourself develop the reading. So with this, we close. Thank you. Thank you very much. And please be in touch with studies. Keep studying. And we are always there at BOS to guide you, to help you in whatever problems you face. So be connected to us. Share your queries. Thank you. Thank you all. Yes, Manishi. Good day.